Hello friends, I am Professor Nisar Ahmed Khan from Department of Economics, Aligarh Muslim University. I will talk about capital market. What is capital market? What purpose it serves? And what are its constituents? These are the questions that I will answer during my lecture. So capital market is a market where long-term funds having maturity of 1 year or more than 1 year are traded. Capital market helps the businessmen, production units and farmers to meet their requirement of long-term funds. These long-term funds are needed to purchase fixed assets or create fixed assets. More importantly, in these fixed assets are the machines. So the funds procured from the capital market is a financial capital which help in procuring physical capital, while the money market meet the requirement of the business units and production units and farmers of short-term funds. That is called as circulating capital or working capital. Or you can say that money market help in meeting the businessmen day-to-day expenditure. That is the funds required to meet day-to-day expenditure, I should say. While the capital market help the businessmen or the production units or the farmers to meet the requirement of long-term funds for procuring fixed assets. So, you know the cost is divided into two parts, the fixed cost and the variable cost. The variable cost, you need funds for it. To meet the variable cost, you need the funds for a short period. And to meet the fixed cost, you need the funds for a longer period. So capital market is very important market. You may know that what is capital. In economics, capital is defined as man-made instruments for further production of wealth. Capital is a man-made instrument used for further production of wealth. So it is not given by nature, unlike land, unlike water or other resources. This is a man-made instrument. Now this man-made instrument, for procuring this man-made instruments, for producing this man-made instrument, we need long-term funds. That is known as financial capital, which help in creating or procuring physical capital. Now this organized capital market, there are several constituents of the capital markets. We will talk about the constituents later on, but first we will talk about the players in the capital market. What are the players in the capital market? So one player in the capital market is bank. That is all type of banks. Banks cover the commercial banks, the banks covers development banks, banks also covers the merchant bank or investment bank. The other player in the capital market is government. Government also purchase and sell the bonds and securities in the capital market, and capital market is also very important for government for procuring or for borrowing funds for a longer period to carry out the developmental activities in the country to create necessary infrastructure. The third participant in the capital market are the brokers. That is, brokers help the investors and companies to carry out the transaction, and it helps the investor to invest and it helps the companies to find the investors. Then there are dealers, and these dealers, they are dealers in the securities, so they have a stock of securities and made these available to the prospective investors. Then there are underwriter, or we can club them together, we can say that companies providing investment services. Provider of investment services. And if we write provider of investment services, then brokers are also providing investment services, so we can remove this broker from here. But if you want to mention, we can mention it here. So brokers also provide investment services. So we can modify this list and we can make it like this. So the provider of investment services, we have the brokers, we have the transfer agents, we have the companies which help which have companies, institutions which help the companies or promoter to sell the shares and which help the investor to make the investment. Then there are other participants also in this market, and these are like insurance companies, or we can club them together and we can write them as non-banking financial intermediaries. Non-banking financial intermediaries. Besides that, we also have the exchanges, that is the stock exchanges. We have exchanges, and we also have regulatory bodies. Regulatory bodies in India, the capital market is mainly regulated by Securities and Exchange Board of India, that is SEBI, that is one organization. Then we have another one which is Insurance Regulatory and Development Authority, that is another organization. And then we have Pension Fund Regulatory and Development Authority. Besides that, the government, the Ministry of Finance, the Company Affairs Department, and the Commerce Ministry, Ministry of Law, they all are responsible for regulating this capital market in India. The Ministry of Law may be involved only when some legal issues comes in. So these are the participants in the capital market, and we have also told you about the regulatory bodies of the capital market with reference to India. Now I will come back to the original slide in which we have capital market, and we will talk about the components of the capital market or constituents of the capital market. the capital market is broadly divided into two parts: organized market and unorganized market. We also divided money market in the same way, that is in organized money market and unorganized money market. The meaning of organized and unorganized money market here is also same as it was in the money market. Unorganized market is a market which falls outside the control of the regulatory authorities. Here the rules and regulations of the regulatory authorities or regulatory bodies are not observed. And as far as organized market is concerned, this is well within the control of the regulatory authorities, and the rules and regulations of the regulatory authorities are observed. I have told you earlier while discussing money market that this over a period of time, as economy develop and as financial market develop becomes more efficient, then this share of unorganized market go on shrinking and it becomes smaller and smaller, and contrary to that, the share of organized market becomes larger and larger. So this organized market can be further classified. Here we can have loans from banks and non-banking financial intermediaries. Non-banking financial intermediaries. These are the loans given by the banks, and remember the same thing we also have in the money market, but then the loans which are granted for a period of less than 1 year are covered in the money market, while the loans for a period of 1 year or more than 1 year are covered in the capital market. But the loans are same granted by banks and non-banking financial intermediaries. In the non-banking financial intermediaries, we have loans from term lending institutions, from the finance companies, maybe from mutual fund companies, and also from insurance companies if they grant loan. Then we have another segment of the money organized market, and that market is known as securities market. So we have here securities market. Securities market. Securities market is a market where the bonds and shares, that is equities, are sold and purchased. Different type of bonds, different type of equities are purchased and sold. More specifically, we can call the securities market is a market where securities are traded. And then we have another segment of the organized capital market, and that is known as derivative. Derivative market. We will not talk about derivative market because we will be delivering a full-fledged lecture on derivative. So, we will now come again to the securities market. Now, these securities are of two types. We have government securities and we have industrial securities. The government securities may be new or may be old. The market in which government new securities are sold, that we can call as primary market, and the market in which the old securities of the issued by the government are traded, that we can call as secondary market. The government securities are usually issued through or rather sold through auction. So, the rate of interest in case of government securities is determined by the market, and these securities are sold on discount. And some of the but it does not mean that all the government securities are sold on discount. The securities carrying fixed rate of interest may be sold at on par value, but securities where the rate to be determined by the market may be sold through auction, because what will be the rate of discount, at what rate these securities will be discounted, that will be determined by market, and this discount rate is nothing but simply the rate of interest. So, the market for old securities, here the primary dealers play a very important role, because they have stock of government securities which they can make available to the investors as well as other financial institutions. Now, we have industrial securities. In the industrial securities, we have the market is secondary market, and we have primary market. Primary market is a market in which the brand new securities are sold, and the secondary market is a market in which the securities already issued, that is old securities, are traded, purchased and sold. Now, this secondary market, we have exchange, exchange means stock exchanges where securities are traded in an orderly manner. That is, there is a designated place, there is a designated time, and there are members there are brokers who are the members of the stock exchange, and only they are authorized to trade securities at a designated time, that is during business hours. So, there are rules for doing everything, there are norms already prepared, and everything is formal in case of stock exchanges. But there is another market which we call as over the counter market. Over the counter market is simply a network of the dealers, brokers and others who are linked through internet, telephone and maybe SMS, and they carry out buying and selling of securities. There is no fixed place, there is no designated time. This type of transaction may take place at any time, at any place, and they provide customized services. Usually in the over the counter market, the securities which are not listed in any stock exchange are traded. Then the type of securities which are traded in stock exchanges and over the counter market may broadly be divided into three parts. We have bonds, and we have equities, and we also have preference shares. So, we will tell you about the bond, the meaning bond as to what do we mean by bonds and what do we mean by equities and what are preference shares when we will discuss as financial instruments. So, at this point of time, I am not going to explain bonds, equities and preference shares. But as far as secondary market is concerned, Then trading in secondary market, there are different types of trading that takes place in the secondary market, that is in stock exchanges, because stock exchanges are the main component or main constituent of the secondary market. Over the counter market, here the securities are all again traded in this market also, but the securities of um, smaller firms are the companies whose securities are not listed in stock exchanges. Only those securities are traded in over the counter market. So this market, over the counter market, is basically for the small companies, whereas in the stock exchanges the trading of those securities takes place who are listed in the stock exchanges, that is all type of securities are not traded in the stock exchanges. Now trading in these stock exchanges can be of several types. So what are different types of trading in stock exchanges? One trading type of trading is known as intraday trading. Intraday trading means that where the trader purchase the bonds, purchase equities or securities maybe in the morning, but sell the securities before the day is closed for trading. So the position is closed on the same day, that is buying and selling of the securities takes place on the same day, and that is why we call it as intraday trading. On the same day securities are bought, on the same day securities are sold. So they try to take advantage of the fluctuation in the securities prices during on a particular day. Then we have scalping. Scalping. Scalping means that here the securities are bought and sold within seconds or minutes. That is, here the trader take advantage of very short term fluctuation, in the securities market, because securities prices keep on fluctuating from second to second, and therefore the scalpers, they take advantage of this very short term fluctuation in the securities prices. So within a second they complete buying and selling both. That is, at one point of time, maybe in this one within 1 minute they purchase, and the same minute they also sell the securities. That is known as scalping. Then we have another one which is known as swing trading. Swing trading, in case of swing trading, the trader keep the securities for some days or week, that is, purchase the securities, keep the securities, observe, and then after few days or after few weeks sell the securities. Position trading. This is another type of trading known as position trading. In case of position trading, the trader may keep the securities for a longer duration, that is for months, for years. That is, the trader wants to take advantage of the fluctuation in the securities prices over a longer period of time, and that is why we call it as position trading. Momentum trading. Momentum trading, here the performance of the firm, performance of the company in recent past help the trader to decide whether he should purchase the securities of this company or not. That is, he purchased the securities of the companies who have performed well in past. So he thinks that the performance by the company in recent past is going to continue in future, and consequently he purchased the equities and bonds of that company in the hope of getting profit when if the performance continues in future too. Then we have another type of trading which is known as technical trading. In the case of technical trading, the trader prepare chart, analyze data, and by analyzing data, by preparing the chart regarding the performance of different companies in past in over a longer period of time, and after the analysis decides which companies are going to do or likely to do well in future and purchase the shares and bonds of those companies. So here the things are much more technical. That's why this is known as technical trading. Then we have fundamental trading. Fundamental trading is basically, here in this type of trading, the trader looks at the fundamentals of the companies and he thinks if the fundamentals of the companies are strong at present, then it means that the company is likely to do well, and the share prices of these companies, the bonds issued by these companies, will perform well in future. So the trader here basically goes by the fundamentals of the company, that is, how strong are the fundamentals of the company. Then we have the last one, which is known as delivery trading. Delivery trading is a traditional trading, where trading is done to hold the shares for a longer period, and here the shares or bonds are physically delivered, and these bonds or shares are transferred in the name of the person who has purchased these bonds and shares. Usually the intraday trading, scalpers, swing trading, they are all speculators. They do not get these securities transferred in their name, because if they get transferred in their name, then they have to pay stamp duty. So they purchase the securities, wait for the opportune moment, and as soon as they think that now it is good to sell the securities, it is profitable, they sell. But in the case of delivery trading, the securities are formally transferred to in the name of a person who has purchased these shares. Now, as far as shares are concerned now, or bonds are concerned now, we have in India Depositories Act 1996, and since then the securities are kept in demat form. There are depositories, and these depositories they work like bank, where the investor can deposit his or her securities, and these securities are stored in electronic form. Earlier, before this act was enacted, that is before 1996, now these securities were held in physical form. So these securities were destroyed during fire, during flood, or maybe because of other reasons, and these securities were also lost during transfer when they were sent to the company for changing the name of the owner. So, but now securities are stored in demat form, dematerialized form, that is in the electronic form, by these depositories, and these so there is no question of losing these shares in say fire or flood or transition. Now, because these securities are now stored in electronic form, the buying and selling of the securities, the transfer, all this has become very, very easy, and it consumes less time and it is also less costly. So, we have two depositories here. One is known as CDSL, Central Depository Services Limited, and another is NSDL, National Securities Depository Limited, that is NSDL, and then we have depository participant. Depository participants are the agents of these depositories, and they act as agent. These depository participants are usually the brokers, banks, and other agencies providing investment services. So, this act was enacted in 1996, and since then efforts are being made that all the securities which are in the physical form should be stored in these depositories in electronic form, and the investors are being persuaded and convinced to do it, and it is in their own interest, and we see that large number of securities till date have been converted into electronic form, that is in demat form, and they are no longer held in physical form. In case of new issues, it has become mandatory to have a demat account. If you don't have demat account, then you are not likely to be allotted the shares. So, now we come to the primary market. The primary market, this market we come primary market. In the primary market, the new shares or new bonds are being issued. A company intending to issue new shares or new bonds or new stocks, then company has to do, there are three steps that company has to follow, and these three steps are very, very important. The the first step in the issue of shares is origination. So, any company intending to issue shares has to go through these three steps. Origination. Origination means investigating the viability and prospect of the project, that studying the technicalities of the project, that is where from this machine will be procured, where the project will be located, where from we will get the water, where from we will get the labor, and what type of technology will be used. Each and every details are investigated. That is, we have a technical appraisal, we have a financial appraisal, we also have economic appraisal. Now, this investigation is to be carried by an agency, by an organization which has very good credibility and a reputed organization and have necessary technical staff. So, investigation or scrutiny and approval by a credible agency will go a long way in persuading the prospective investors to purchase the shares. So, because as far as ordinary shareholders are concerned or ordinary investors are concerned, they are not literate enough, that is in terms of finance, they do not have that much financial literacy that they can decide regarding the viability and prospect of a particular project, and they do not have the necessary technical ability as well. So they go by the report of this credible and reputed organization. So origination is the first step. The second step is underwriting. Underwriting means a guarantee to purchase a fixed portion of the shares if these shares remain unsubscribed. So, a fixed proportion of the new issue, you can say, that is going to be purchased by the underwriter if these shares remain unsubscribed. If there are no takers for these shares, then underwriter purchase. For example, 10% of the new issue or 20% of the new issue or 15% of the new issue. If these shares remain unsubscribed, then the underwriter takes guarantee to purchase that. Now, underwriter doesn't do this job free of cost. Underwriter charge a fee. The underwriters are usually banks, investment banks, term lending institutions, and other non-banking financial intermediaries. Then we have the third step, and that is known as distribution. Distribution means that selling the shares among the public, that how to distribute these shares among the public. Here the company is held by the network of the brokers. This we find that brokers have their sub-brokers, their agents in almost spread all over the country, and they help in this process to the company to sell the shares to the public. So these are the three steps. Now we'll come to the methods of floating new issues. What are different methods of floating new issues? Methods of floating new issues. So there are different methods for floating new issues. One method is by issue of prospectus. By issue of prospectus. You may be knowing this method because you must have taken admission in an university or an institution, and that institution issue prospectus as well as application. In the prospectus, all details about the institution is given, and you can read that, and if you are satisfied, then you can fill up the application and submit it for admission. But it's the same thing is also in case of company, that a company going for new issue, then company has to prepare a prospectus, and in the prospectus all details about the company are given. It may be up to 3 pages, and both the positive aspect of the company as well as negative aspect of the company are given, because there are norms that should be satisfied, and these norms in our country, that in India, is decided by the SEBI. So as per the norms of the SEBI, this prospectus has to be prepared, and the investors will read the prospectus and fill up. If they are satisfied, they will fill up the application. So by issue of prospectus, we have one method that is known as initial public offer. Initial public offer, IPOs. Initial public offer means that when a private company is going to issue the shares to public for the first time. So company is going to be from private limited to public limited. This is also called as going to public public. That is, the company has decided to share its ownership with the investors. So that is what we call as initial public offer. Then we have another one which is known as follow-on public offer. Follow-on public offer. Follow-on public offer means that here the company has already issued share to the public, and company is also listed, and the company require additional funds, and consequently company is again issuing the shares to the public, and that is known as follow-on public offer. Then we have another method for issuing shares, that is new shares are floating new issues, and that is known as offer for sale. Offer for sale in India was introduced in the year 2012, and since then the private companies as well as government are taking full advantage of this opportunity of offer for sale. Offer for sale means that here the company uses the trading platform, that is stock exchange, to sell the shares to retailers as well as institutions. There are a number of steps involved in offer to sale. The first step is the company has to make announcement, a public announcement, that company is going to sell these shares, and this announcement should also be available on the website of stock exchanges, so that the prospective investors know that company is going to offer shares. The second step is the company also have to mention in that the minimum price, the floor price, that is the shares will not be sold below this price. So all those who are willing to purchase the shares, they have to quote a price above that, that is the minimum, above the minimum price. The second step is bidding. That bidding, there is a bidding period, that is when the bidding opens and when the bidding closes. During this period, the bidders are supposed to submit their bid, in which they mention two things. One is the price at which they are going to purchase the shares, and the number of shares that they are going to purchase. Once bidding period is closed, then comes the allocation of shares. Now the company allocate the shares among the bidders. Now these shares may be allocated at a single price, that is all the bidders get the shares at the same price decided by the company, or there may be multiple price, that different bidders getting the shares at different prices. And last stage is settlement, that is all those who are allotted shares, they have to make payment and the amount is deducted from their account. So these are the steps involved in offer for sale. Then the third method is private placement. Private placement is suitable for in a situation where the size of issue is very small, that here all the shares by which company is going to issue are placed at the disposal of a private party. That is, the job of the company is over, and this is a very quick way of selling the share. Now it is for the private party to keep the shares or to sell to the general public. But as far as the company is concerned, the company's job is over, company has sold the shares. But this is not suitable if the number of shares that company is going to issue is very, very large. This is suitable for small issues. Then we have right issue. Right issue is also suitable when the company is going to issue a small number of shares. Here the company issue the shares to those who are already holding the shares of the company in a particular ratio, and that is decided in advance, and SEBI is also informed about that. For example, if you are already holding 10 shares of the company, then you may be allotted 2 shares, that is the ratio is 10 to 2. That ratio is decided by the company and it is very transparent. So that is right issue. It means that here the shares are not going to be allotted to a new person. Only the persons who are already holding the shares, they are institutions who are already holding the shares, they are allotted the shares. Now all these things, all these methods of issuing new share are very transparent, and there are norms prepared by the SEBI. These norms have to be followed. SEBI usually does not interfere, but SEBI keep a very strict vigil on all these things, and as soon as violation takes place, SEBI take very strict action, and that's why that SEBI does not interfere in the process. Thank you very much.